वेलकम टू वीलर्न में आपका स्वागत है। We are discussing banking operations, session 5, liquidity, reserve management and investment. Topics covered are liquidity management in banks, need for liquidity management, statutory requirement of maintaining reserve, cash reserve ratio, statutory liquidity ratio, factors affecting the bank's liquidity, securities approved for SLR investment, asset and liability management, liquidity management and control procedure, liquidity management and fraud protection, and investment management. Liquidity management in banks, when we discuss, जितनी भी sound और prudent liquidity policies होती हैं, they basically become the source and they are therefore the amount of liquidity which is required to ensure that there is adequate continuation of operations and to meet all applicable regulatory requirements. So these are the policies. They must be very much supported by an effective procedure to measure, an effective procedure to achieve and maintain liquidity. There are operating liquidity. It is basically that level of liquidity which are required to meet the day-to-day, daily operations, outflows and cash flows commitment. So operating requirements, they are basically met through the management of assets and liabilities, and there are certain techniques for controlling the cash flows which are supplemented by assets, those who are readily convertible to cash, or by an institution's ability to borrow. Now when we talk about, there are certain factors which affect an institution's operating liquidity. The first is that the cash flows and the extent to which the expected cash flows from maturing the assets and liabilities, they match with each other. Second is the diversity or the reliability and the stability of the funding source. So the ability to renew or replace for regulatory purposes, an institution therefore is required to hold a specific amount of assets which is called as liquid, and based on this deposit liability. Now there are certain importance of liquidity management. First importance is background. So when we talk about background, the overhaul of the country's payment system, it is by the Reserve Bank of India, and it is basically to bring about structural and operational changes that will have a very great effect on the way banks do their business, and in particular they would affect the treasury departments of the bank and on the way they manage their intraday liquidity. So these changes, they will create a need for the measurement of payment flows, and they usually use the methods of queuing up techniques and which regulate the payment flows. Therefore better communication and a generally higher awareness by the treasury department or the manager of payment processing is done. Second is complexity and impact. So the problem of liquidity management is also made more complex because the funds management or the treasury management department in banks, they would be connecting to different payment infrastructure, and this will necessitate the management of multiple intraday liquidity positions. So bank would be required to put in processes or procedures and information technology system to establish liquidity and operational bridges between these various infrastructures and systems. The last is the liquidity issues when we talk about. The causes of liquidity fragmentation, they can be broadly classified into operational, technical, policy and bank procedure. It must therefore be understood the first three classifications, and that is operational, technical and policy procedure. They refer to the procedures or operations of payment system, while the bank procedure, they refer to the actual use of the system by the participating bank. However, in the case of liquidity pools, if they stick to the rule of the game and they implement the best practices, it should be very few payment problems that exist, such as gridlocks and end of the day position and liquidity swap. When we talk about the need of liquidity management, liquidity management की need तभी arise होती है, and it arises from the central bank's concept of liquidity, which is measured in terms of monetary base. Now the supplier of the monetary base of the central bank, it is basically dependent on the the public's demand for currency, which is basically determined by the size of the monetary transaction and the opportunity cost of holding that money. Secondly, the bank system, they need to reserve to settle or discharge the payment obligation. Now the importance of central bank liquidity management, it basically lies in its ability to exercise a considerable influence and control over the short-term interest rates by small money market operations. Now when we talk about this ability, it is basically determined by the credibility of the central bank itself. There are certain interventions that the central bank makes that have a very pronounced signaling effect. Now the liquidity management function of a central bank, it involves a larger economy-wide perspective. There are central bank liquidity management that has short-term effects in the financial market. However, the long-term implications for the real sector and on the price level, they are also very important. When we talk about the statutory requirement of maintaining cash reserves, now with the aim to monitor the compliances with regard to the statutory reserve requirement. The statutory reserve requirements, when we are talking about cash reserve ratios, CRR, and the statutory liquidity ratios, SLR. So they are basically scheduled by the commercial banks. The Reserve Bank of India, they have prescribed statutory returns in Form A of CRR under Section 42(2) of RBI and Form 8 return of SLR under Section 24 of the Banking Regulation Act 1949. When we talk about the reserve requirements, that is cash reserve ratio and statutory liquidity ratio. Stat reserve ratio, when we talk, there is a requirement of maintenance of CRR. Now Section 42(1) of RBI Act 1932, scheduled commercial banks, they are required to maintain with the RBI an average of cash balance, the amount of which shall not be less than 3% of the total of net demand and liabilities in India, or a fortnightly basis, and an RBI in this case, it is empowered to increase the said rate of CRR to such higher rates which are not exceeding 20% of the net demand and time liability under the RBI Act. Another is maintenance of incremental CRR. When we talk of section 42 subsection 1A of RBI Act 1934, the scheduled commercial banks, they are required to maintain, in addition to the balances prescribed which are under section 42 subsection 1 of the Act, an additional average daily balance, the amount of which shall not be less than the rate specified by the RBI in the notification which is published in the Gazette of India. That could be additional balance being calculated with reference to the excess of the total of NDTL of the bank as shown in the return referred to in section 42 subsection 2 of the RBI Act 1934. Now there are scheduled commercial banks. They are also exempted from maintaining an average CRR on various liabilities. So the first liability is basically liabilities to the banking system in India as computed under clause D of the explanation of section 42 subsection 1 of the RBI Act 1934. The second is credit balance of ACU, that is US dollars account. The third is transaction in collateralization, borrowings and the lending obligations. And the last is demand and time liability in respect of their offshore banking units. So although the scheduled commercial banks, they are exempted from maintaining average CRR on these liabilities, they are required to maintain 3% statutory reserve thereon. So the commercial banks which are scheduled, they are not required to include interbank term deposits of the original maturities of 15 days and above and up to 1 year in the liabilities to the banking system. When we talk about statutory liquidity ratio, so in terms of section 24 subsection 2A of the BR Act 1949, all the scheduled commercial bank, apart from their average daily balance, they are also required to maintain in India, when we talk about, in cash, second in gold valued at a price which is not exceeding the current market price, and third an unencumbered approved securities which is valued at a price specified by the RBI, an amount of which shall not at the close of the business on any day be less than 25% or such other percent that is not exceeding 40% as the RBI may from time to time by any notification it is prescribing. So at present all the scheduled commercial banks, they are required to maintain a uniform SLR of 25% of the total of their demand and time liabilities in India as on the last Friday of the second preceding fortnight, which is basically stipulated under section 24 of the BR Act 1949. Now there are certain factors which are affecting the bank's liability. The first factor is the change in the bank rate. Bank rate is basically a rate at which RBI allows finance to commercial bank. So bank rate is thus a tool which RBI uses for short-term purposes. Now any revision in bank rate by RBI, it is a signal to banks to receive deposits rate as well as prime lending rates also. Another is changes in CRR. All scheduled commercial banks, they are also required to maintain a fortnightly minimum average daily cash reserve which is equivalent with the RBI. And that ratio vary between 3 and 15%. There is another factor like change in the statutory liquidity ratio. So every bank is also required to maintain at the close of business every day a minimum proportion of their net demand and time liability as liquid asset in the form of either cash or gold, in addition to their cash reserve requirement. The fourth is repos and reverse repo operations. RBI in this context is also empowered to enter a transaction in which two parties they agree to sell and repurchase the same security. Open market operations of RBI. It is an instrument of monetary policy which involves buying and selling of government securities by the RBI to influence the volume of cash reserve with commercial banks, and thus it influences their loans and advances. Now, securities which are approved for SLR investment, when we say, they are those securities which will be referred to as the statutory liquidity ratio securities. So these are first dated securities which are issued up to September 8, 2009. Second is treasury bills of the governments of India. Third, dated securities of the government of India under government borrowing program. Third, state development loan of state governments under their market borrowing program. Now when we talk about asset and liability management, so liquidity किसी भी बैंक के लिए ये मतलब होता है so that they are able to meet their financial obligations as and when they become due. So bank lending finance investments, they are relatively illiquid assets, but it funds its loan with mostly short-term liabilities. When we talk about asset management banking, commercial banks, they differ widely in how they manage their liquidity. So small banks, they derive its funds primarily from customer deposits, and they are normally at a fairly stable source which is in the aggregate. So its assets are mostly loans to small firms and households, and therefore it usually has more deposits than it can find creditworthiness borrowers for. We can also discuss liability management banking. So herein large banks generally lack sufficient funds to fund their main business, and the main business, they basically deal with large companies or governments and other financial institutions and wealthy individuals. So most of them, they borrow the funds they need from other major lenders in the form of short-term liabilities, and which must be continually rolled over. This is referred to as the liability management. It is a much riskier method as compared to the asset management. So a small bank, they will lose potential income if it gets its asset management wrong. A large bank that gets its liability management wrong, they may fail. Now there is a key to liability management when we talk about it. So the key to liability management, it is basically always being able to borrow. Therefore, a bank's most vital asset is its creditworthiness. Now, if there is any doubt about its credit, lenders can easily switch to another bank. So the rate a bank must pay to borrow, it will go up rapidly with the slightest suspicion of trouble. There is liquidity management and control procedures when we talk about. So जितने भी लाइसेंसी होते हैं, उनको ये बहुत ज़रूरी होता है कि वो डेवलप करें और इम्प्लीमेंट करें एक ऐसा इफेक्टिव और कॉम्प्रिहेंसिव प्रोसीजर और एन इंफॉर्मेशन सिस्टम so that the management and control of liquidity is basically in accordance with the liquidity and funding price. So these procedures, they must be appropriate to the size and complexity of the institution's liquidity and funding activity also. Internal inspections जो होते हैं या फिर audits होते हैं, they become a very key element in managing and controlling an institution's liquidity management program. तो जितने भी institutions होते हैं, they are required to use them to ensure that the liquidity management, it basically complies with liquidity and funding policies and the procedures. Now, when we are talking randomly testing all the aspect of liquidity management in order to first, it helps in ensuring liquidity and funding policy and procedures which are being adhered to. The second is it ensures a very effective control which is applying to managing liquidity. The third is it helps in verifying the adequacy and accuracy of management information reports. And third, lastly, it helps in ensuring that the person who are involved in the liquidity management, they fully understand the institution's liquidity and funding policy. They must also be experts. There are certain expertise which are required to make effective decisions. Now, liquidity management and fraud protections. When we talk about liquidity management को effective होने के लिए there are 3 steps which it involves. The first step is the treasury identification. The second is the manage and the third is optimizing liquidity. ये जितने भी steps हैं ये अपने आप में interdependent हैं and all of them they require the successful implementation. Now what happens? There are certain steps जो कि liquidity management में involved हैं. पहला जो step है वो होता है improving the visibility with regard to centralized payment workflow and approval. The second is a reduced cost with electronic execution of payment, and third is the reduce fraud and erroneous payments when we talk about. So the economic downturn is basically affecting how financial institutions they manage their liquidity in a number of ways. So it has particularly affected the liquidity of the financial instrument portfolios, which now need to be thoroughly reappraised. When we talk about investment management, so there are deposits which are mobilized by the banks, and they are required to be deployed either in loans and advances or in the investments. Now, while doing this activity, every bank, it must ensure and take care of the credit risk or the market risk. The proportion of such deposits they are not lent are invested either in the SLR securities and on non-SLR securities. There are certain functions of investment department that can be first is to maintain the SLR. Second, the maximization of yield on investment. Third is matching maturity of investment with those of the deposits and borrowings. Fourth is managing investment in the capital market. And lastly, optimization of interest cost through repos in case of sudden shortages. To exercise, sound liquidity management involves prudently managing assets and liabilities. Second, demand and supply of money does not affect the liquidity with the banks. Thank you and have a nice day. Keep learning and relearning.